No, well, look, I think we've had a few Fed speakers now building this message, starting with John Williams right before the holidays, after the press conference, and then we've had a couple of them adding to that message of flexibility and patience and not downplaying the message from the market, saying the markets might be seeing something that we're not, that's not in our baseline. If it materializes, we will recalibrate accordingly. So I think that they've been trying to get that out. It was a nice 1-2 punch between the employment report and Powell this morning.
So, Gabriela, did Powell say the right script for what investors were hoping for?
So I think there was less of a change in actual policy, a little bit more change in communication, a little bit more acknowledgement of downside risks and flexibility. That was important.
But that is policy when you look at the balance sheet.
But one thing I think that's interesting to mention as well, whether it's communication or policies, also just the magnitude of the moves over the past 2.5 weeks. There is not a fundamental reason for those moves. I think that's what the Fed believes, that's what we believe. But the moves in and of themselves may alter the fundamentals, right? We did have a big move down in energy prices that is going to affect inflation, less pressure on the Fed in that sense. And we did see a big move down in equity markets that may affect confidence even further. So I think it was an acknowledgement of what actually happened over the past 2.5 weeks, a tweaking of the message rather than a big change in policy in and of itself.
And so, Rick, just assess for us how the bond market is incorporating what Powell said today, right? You have some relaxation of yields across the curve after a day yesterday when you really did have some intense compression all across the curve.
You know, to me, the biggest reaction in interest rates moving up today really was the jobs number and the fact that the equity markets did so well and ran with it afterwards. Now, with respect to how much of the the stock market had to do with the Powell get-together, I can't say. But I can say this. I think that out of the 3 people on that stage, 2 former and 1 current, I think that the market was pretty happy of Jay Powell being in the leadership role. And how can we say that? Because Powell is much more of a give-and-take person. See, we're all talking as though words can come out of the Fed or the statement, and they're going to be absolutely perfect. Every answer of this human being in a press conference is going to be perfect when the whole world's parsing every syllable, counting every word. October 3rd, automatic pilot. These may be just faux pas. But I think that Ben Bernanke and Janet Yellen are much stricter in how they approach the market, more in modeling, less in kind of feeling out what's out there like Jay Powell. And my guess is if you're really going to thread the needle on normalization agitation, which is really what's going on here, that Powell's the perfect guy for it.